Hey guys, so I just watched this video from Financial Education and he titled this Three Potential Stocks to Turn 1,000 into $1 million. And that is a pretty crazy claim. And the three stocks he goes over, one of them I actually own. He goes over SOFI, which I own. I'll give you my thoughts on that. He also goes over The Honest Company and FUBO TV. So we're going to look at two of those stocks. I'll give you my thoughts on those stocks. And then I'm going to go over some of my own stocks that I think that could, if he thinks these three stocks could go to 1,000 to 1 million, then why can't my stocks? So I'm going to show you three that I have some really high potential in that I'm really convicted in. I'm going to be showing you all their financials and what is the business actually doing, because you've probably not heard of some of these companies before. So I'm going to take you through their investor presentation, and these are all really cool companies. So yeah, hopefully you'll stick with me. Don't forget to drop a like on the video, and let's just first I want to talk about SoFi and FUBO TV stock first. So first, let's check out SoFi stock. So I do actually own a healthy amount of shares. I own 30 shares, not a crazy amount. I recommend, you wouldn't want to go all in on just one of these risky stocks like this, but the market cap is $9.5 billion. So a pretty decent sized company, but still not crazy big where the other banks are going to worry about them. Look at their top line revenue growth. I mean, it's still up 20% year over year. I mean, look at this consistent growth of their top line revenue. I mean, this is very impressive in my opinion. And also, if we just go look at their net income, they're finally net income positive. I mean, if we zoom out, they used to lose a bunch of net income. Now, in the three most recent quarters, and in the future, they're going to keep on being net income positive. So that's a really good sign for SoFi. And on top of that, they have a really healthy balance sheet. And the bank stocks usually have high asset to liability ratios, so this is completely normal. But look at their assets growth. It's at 32.5 billion right now. If we just zoom out to like 2022, it was 12 billion. So more than doubled since then. So this is some really good growth on their top line revenue. And check this out. Look at their total long-term debt. It's actually down 52% year over year. So this is a great sign. They've been paying off a lot of debt. So that means, less interest expense as well. So only $3.11 billion of debt. Remember, their market cap was like $9 billion. And on top of that, they even started doing some share buybacks. So look at that. They bought back $323 million worth of their own stock in the most recent quarter. So that's a great sign. They're even buying back their own stock at, what I think was a discounted price. So that's my thoughts on SoFi stock. I do own them, so I might be a little biased, but I know a lot of people probably own this one and are bullish on this, but I got to keep it real with you guys on why I don't love FUBO TV stock and why has the stock fallen so much. I'll go ahead and explain that right now. So I'll show you what I do like about this company. Look at their impressive total revenue growth. Look at their sales growth. It's up 25% year over year. I mean, this grows every single year. They keep getting more and more subscribers. So this is very impressive. This is the one thing I do like about this company. Very impressive sales growth. But also, this company is not net income positive yet. So they've actually not made any net income yet so far. So hopefully this company can get profitable soon. But that's not even why I dislike this company. Here's actually my problem with FUBO TV stock, and that's their problem with diluting you as a shareholder. So check this out. This is their total common shares outstanding. It's up 12.57% year over year, but look at the number of shares. It's at 329 million. If we just zoom out from just a few years ago, you've been more than diluted by half. It was 140 million. And when they IPO'd, it was, less than 10 million. So they've diluted you so much as a shareholder. And that's what's concerning to me about FUBO TV stock. That's why I think it's at $1.59. And I have a little bit of concerns for FUBO TV, but that's the only bad thing I have to say about that. Besides that, their total revenue growth is good. And their balance sheet isn't great. And the last stock he went over is The Honest Company. And he made a good point that this company actually has zero debt and $35 million of cash. And if you look at the market cap, it's $350 million. So they have 10% of their entire market cap just in cash. That's The Honest Company and zero debt. And I have another company that here's one of the stocks on my list. So check this out. This one will probably be a bit controversial, but I can't wait to show you this one. So this is Perion Network. So this company is completely debt-free, and they have a net cash position. So they have cash right now of $400 million. And look at their market cap, as you see in the top right. It's $374 million. So this is a company that's trading at less than their cash on hand. And this company is completely debt free. They have zero debt. But then you're probably wondering, why has the stock gone down so much? As you can see, I'm down a lot of money on this stock. I do own this one, so I could be a little biased. I'm down over $1,000 on this stock. It's our biggest loser. But here's why this stock has fallen so much. So this company actually just lost a contract with Microsoft. Basically the biggest company in the entire world, or second biggest by market cap. So this is what I looked at when I saw their financials. Look at their EPS. They were very consistent with their EPS. Now, in the most recent quarter, they lost EPS because they lost their contract with Microsoft. And that's the one bad thing about this. But I'm going to show you some other parts of the business that are growing dramatically year over year. So here's the good part about Perion Network. All right, so now let's look at their most recent investor presentation, because I think it's important to understand what they do. This is a pure advertising stock, and they reach you at pretty much every point of the day is what they say right here. But check this out. Here's their main growth engines. They start with the highlights, then at the end of the slides, they get to the bad stuff. But check this out. They're a pure advertising business through retail media, digital out-of-home advertising, and CTV. So look, this is up 75% year over year, 42% year over year, and 41% year over year. My thoughts are, because they lost their contract with Microsoft, they're trying like crazy to grow the other segments of their business. So here's their advertising channel for brands. So here's their CTV solutions. Check this out. We can kind of see some of their customers, Altria Group, Adidas, Google. We can see that their growth year over year went from 35 million in 2022 to now in 2024 of 10 million in this quarter. So this is their CTV business. Now here's their retail media solutions. Check this out. This went from 6 million to 17 million, or from 1 year ago, 10 million to 17 million, which really is a 75% year over year growth. So that's really cool. We can see some of the brands that advertise with them. Scott's Miracle-Gro. Anyone remember that stock? I used to own them at one point. Walgreens, Crystal Geyser. They're like a water. And then also, here's what they say. They do their campaigns on YouTube CTV, which is the second largest ad platform in the US, which is pretty cool. I didn't know Hulu was the biggest. That's the one owned by Disney, which I also own. I also own some Disney stock. But here's their digital out-of-home advertising. It went from 9 million in 20. This is the best part of their business, even though it's the smallest. I think there's so much room to grow here. So this went from 9 million to 13 million, which is a 41% year over year growth rate. They have some, this is like your billboards outside, the digital billboards. So they got Alibaba, WhatsApp, Meta, Burger King. Isn't this the old Burger King logo? Anyway, Sun Life. So here's their stats. They have a 62% lift in store visitations, 4.18% X in almost said football and footfall traffic in key locations. So that's pretty cool. And they have AI-based dynamic brands. So no matter what screen you're on, if you're on an iPad or a TV or a phone, it'll change the ad to, fit the screen, which is pretty cool. They've also been recognized at some awards, whatever. So here is their financial highlights. So here's the bad part about the company. Huge decline in year-over-year top-line revenue. This is their lost contract with Microsoft. They had an integration with Bing, their Bing search engine, or whatever it's called, Microsoft Edge, whatever. Now, Microsoft, I guess, is like, why are we doing a contract with them? We could just do this ourselves. So that's kind of what they're doing. I'm not sure. Adjusted EBITDA fell 81% year over year because of this, and they're not. So here's their non-GAAP net income. It was positive because they have so much cash on hand. They're making a bunch of interest on that cash, but their GAAP diluted net income was negative in the most recent quarter. So that is important to know. But here's the thing. Remember, market cap of 350 or 370 million, net cash of $400 million. So there's the risk to reward here. I mean, be honest, even though they might lose some more money for a little bit of time, they have their growing, three segments of their business. They have a lot of cash to get through this. They don't pay a dividend. They even could do share buybacks at this suppressed price. They are doing share buybacks, matter of fact. But we can see here's the revenue. Since they lost their contract with Microsoft, as we can see, it's like the lowest it's been for a while. So that is normal. So here's their advertising solutions, but here's what I'm talking about right here. So this is their search advertising revenue that came from the integration with Bing. Look at how it's down like crazy, down 57% year over year. So, or down 40% year over year, whatever. So that's a little bit of an unfortunate event. So yeah, that's kind of all the slides. I really wanted to take you through this company. I do think there is some upside potential. I think the risk to reward here is really good because of the no debt and a bunch of cash. And honestly, I really like, if we can scroll up here, these year over year growth rates, because who knows what it's going to be next year and the years to come. So that's kind of my thoughts on Perion Network. Let me know what you think in the comments. Now I want to show you the next stock I think has a lot of upside potential that could go from 1,000 to 1,000,000. I mean, I'm being to be honest, that's a super unrealistic claim, but let's keep looking at them. And if you like stocks with a zero debt, kind of like Perion Network and Honest Company, these are all stocks right here that also have zero debt. These are all stocks completely debt free. So that takes a lot of risk off the table, in my opinion, when the stocks are completely debt free. But I want to show you the next stock that I think has a lot of upside potential. I want to give an honorable mention to Powell Industries. This is another company that's debt free. And I really wanted to include this one on the list, but it's at all-time highs right now, but the PE ratio isn't crazy. It's a 24 times earnings at all-time highs, but I just don't believe this one. Literally yesterday, I was like, okay, healthy retrace, but then today, right now, it's at an all-time high. So I don't think I can include this one. We're up over triple on it, so we're not going to talk about Powell Industries, but the next stock I actually want to talk about is Bill Holdings, and I need to buy more shares of this stock. I literally haven't bought new shares for quite some time since June. I'm thinking about buying one more share or a couple more shares of this stock, but I want to tell you why I think this company potentially has a lot of upside room. Like if we zoom out, this stock a long time ago, we should look at it on the weekly chart. So this was when the huge pandemic hype, it was nearly $320. So that is a lot of upside potential. Let's see if we can get back there because here's the thing. This company has kept up its growth rate. If we look at their, where's their total revenue growth? Yeah, here's the revenue growth right here. It's up 16% year over year and it grows every single quarter. So let's actually dig into their financials because I do like this company. All right, so here's Bill Holdings. Remember, I am down on this company and I could be a little biased. So always keep that in mind. And if you are going to start a position in any of these stocks, make it a small allocation because there is still a lot of risk here. But check this out. This is Bill Holdings. As we saw, look at their top line revenue growth. It just consistently grows every quarter, every single year. So this is a great sign. I mean, literally, look in 2020, it was less than 50 million every quarter. Now they're at 350 million just in one quarter. And check this out. If we look at their net income, they're finally net income positive. So check this out. They used to lose a lot of net income, but in the two most recent quarters, they're actually making net income and are expected to keep on making net income for the rest of the time. Not financial advice, not personal advice, but they're supposed to keep on making net income for the rest of the year and for years to come. And let me show you, here's their free cash flow down here. So since they are barely net income positive, we can look at their free cash flow down here. It was actually flat year over year. It was down 2% year over year, but look at the growth of it since 2019 and 2021. I mean, look, they used to lose free cash flow every quarter, and now they're cranking it out. $78 million in the most recent quarter. And all the quarters before this, there's some very impressive year-over-year growth rates. But anyway, let's dig more into their financials. Let's see how much cash and how much debt they have. Are they diluting you as a shareholder? So first off, they have $601 million in short-term investments. So remember, that's $601 million in short-term investments and also $985 million in cash. But why is it down 39% year over year? Why has it gone down so much? I'll show you that. So first off, this company is this was like 2-3 quarters ago, but they are doing share buybacks. Look at that. They bought back 200 million and then 60 million a couple quarters before that. So they are doing some share buybacks, but this company is paying off their debt like crazy. Look at this. In the two most recent quarters, they spent 200 million on the most recent quarter buying back debt. Then, $665 million buying back debt. So if we go and look at their total long-term debt, look how it's gone down from, 1.8 billion to only $900 million. So they're almost at a point where, yeah, actually they are at a point. They have more cash than debt. So this is a company right now that does have more cash than debt on hand. So that's a great sign. And if we go to where's their total common shares outstanding? So check this out. You haven't even been diluted as a shareholder, literally 0.09%. And the growth rate of this company is insane. So you have not been diluted as a shareholder. There's more cash than debt, and they're expected to keep on making net income for the rest of the year. So the PE ratio right now looks extremely high because they lost money in the two other quarters of the year. They lost net income. So if we look at their forward PE ratio, it says a 36. So it is a little high. But if we go out another year or so on their multiple, this company is dirt cheap. Let me show you their investor presentation. All right, so here's Bill's most recent investor presentation. I actually haven't looked at this, so we're going to be looking at this together for the first time. So here's Bill at a glance. We can see their millions or total revenue growth in millions year over year growth rate went from 22 million. We can kind of see the quarter growth. Here's their full year growth. So they're making over $1 billion every single year in total revenue, and their market cap is $6 billion exactly. So they're trading at a pretty low, pretty fair price to sales ratio. 7.1 million network members, 92% net dollar retention rate. I mean, I'm not too sure exactly what that means, but that seems like a really good sign. 92%. Significant opportunity. So let's check this out. The US opportunity. Here's their global opportunity. So they have a lot of room to grow outside of the USA. So that's what they're saying. Really good sign. And integrated financial operating metrics. So yeah, this is really a company where you pay your employees with. There's a lot of small, medium-sized businesses that use Bill Holdings that pay their employees with it. They also do some other stuff, but that's kind of what they're known for. They partner with a lot of trusted financial partners, American Express, Wells Fargo. Yeah, I'm looking for the good slides. So where are the juicy slides? So guess we'll kind of scroll a little bit faster through here. So here's their financial overview. Let's check this out. So 89% of core revenue from existing customers, 6 quarters efficient business model, non-GAAP gross margin. We want their GAAP gross margin is like a couple percent because they just went net income positive. But we expect that to grow over time. Subscription revenue, check this out, fixed or monthly annual rate. So here's actually what we wanted to look at. Here's the slide that's actually good. Price plans, event functionality. But yeah, 19% of the revenue comes from subscription revenue. Then their transaction revenue. So since they have like little cards, they probably get a little fee from every time anyone spends any money through them. And here's their float revenue. Here's what's huge right now. Interest we earn from customer funds while payment transactions are clearing. So they can earn interest off this money, and that makes up 12% of their total revenue. And since we're in a still pretty high interest rate environment, they could probably get 4 to 5% on that money risk-free in the T-bills. So that's another great sign from them. But we can see that that's a pretty big size of their company, literally just from interest on cash. And guess what? That's all really high margin. They don't probably do much work for that. So yeah, they really do have strong revenue growth. Here's as we saw from the first. Oh yeah, here's their float revenue. I'm actually glad that they broke this down. I do like seeing this number. Look at this. Full year 2023 went from 114 to 160. That's like a $50 million of growth, and that's all really high margin. So that goes straight to their free cash flow. That's why they're making a lot of free cash flow right now. And we can see it from quarter and year over year. So last year, this quarter, they made 36. Now they're at $42 million. So that's a great sign. Businesses using our solutions. Oh, here's some more insanely good slides. I really love this. Business using our solutions, 461 to 475. Actually, that's not an insanely impressive growth rate. I'm going to be honest, it's only up 3% year over year. But look at their transactions processed in millions. They went from 23 million to 28 million. So that's actually a really impressive revenue growth, 19%. And total payment volume is up 10%. So hey, there's some good and there's some bad. I'd like to see their business is using their solutions, go up a bit more. But yeah, consistent growth. Yeah, they have very consistent top line sales revenue. So yeah, that was pretty much the slides. So we can see their subscription fees right here. Q4 2023 to, subscription fees actually are down. Look at this. So look, subscription fees from all their places, Q4 2023, 66 million. Q4 2024, 65 million. So, But we can see that their transaction fees went from 192 to 235. So there is a bit of good and there is a bit of bad here. I guess. So you got to always do your own research. Don't put a bunch of money in there. But don't forget to drop a like on the video. Let me know in the comments if you like this kind of video. It was a bit longer, but I really appreciate you sticking to the end. Don't forget to subscribe. But y'all are the best. See you next time.